It's Wednesday, and I feel like we've been absent for a while since we didn't have class on Monday. Hopefully, you all had a good small break. I did check and see to see how the views were on the videos. We have 15 people, 16 people enrolled in this class, and there were like 40 views on this, which yeah, so people watching multiple ways. Actually, I don't know what's going on. Here's the crazy thing, okay? So this is our chapter 12 and 13 homework, which we went over last week. Now you will notice there are 145 views. I actually did the data analytics. I looked into this, try to figure out what the audience is. And apparently, so I don't know, where's the reach? So it's 139 unique viewers, which means that we didn't have a whole bunch of people just going and watching the thing over and over again. And somewhere in here, I was browsing through this, like 80% of this is based on YouTube recommendations. And I'm just like, why is YouTube recommending my videos to just random people on the internet? No, I don't. None of my stuff is monetized. This is just bizarre. Now, there was an explanation. So when I was doing Becker over the summer, I recorded those videos too. One of those videos has like 1,500 views because it was basically auditing section 1, and people were just watching that. That one kind of blew my mind because I didn't actually template that as a class, and it just said auditing Becker, auditing 1. And so apparently people were watching that to prepare for auditing section of the CPA exam. This one, I don't know. This one, 139 viewers just saying, I really want to check out chapter 13 and 14, or chapter 12 and 13 homework. You know, it's just weird. Just weird. Yeah. So some reminders about what we've got going on. So today is our last lecture, our last chapter lecture. So we're almost done with that. Friday we have homework. It's chapters 14, 15, and 16. On the homework, please note that my instructions for the EWC assignment are very specific, and you will be docked points if you don't follow those instructions. So I want to make sure that everybody's clear on the EWC assignment. Do not upload the Excel file. You need to upload one tab from that, which is the I think the evaluation tab. You also need to provide a summary of your results. Those are both detailed in the homework instructions. Please make sure you put both of those up. The reason I have to do this every single semester is because in previous semesters when I've done this, I've gotten just a random mix of whatever people want to upload. Please upload exactly those 2 items for the WC assignment, okay? Yes?
Can we do the summary part in like the Google Doc where we do the multiple choice?
Sure, that's absolutely fine, yeah. So please make sure you make a note of that so that I don't do that. It's a big file. That's why I don't want people uploading it to Brightspace, because I'm not interested in evaluating the entire file. We're going to talk about it in class anyway. So once we're done with that homework, we're done with homework for the rest of the semester. We then have exam number 3. We'll have our exam review on Monday. Study guide and practice exam are already posted, so you can work on those. As before, make sure you come ready to class with questions about the study guide. Make sure you come to class ready with the exam, practice exam completed. If you don't complete the practice exam advance, defeats the purpose. Then we have exam 3 on Wednesday next week, so 1 week from today. I want to clarify. So first of all, everybody should take advantage of the fact that the exam's on Wednesday, which means I have office hours pretty much all day on Tuesday. So if you have questions, come see me. If you can't see me in person, send me an email, ask questions. There's not been nearly as many questions as I would expect for an audit class at this point in the semester, which either means I'm doing an exceptional job, or it means that people are not asking as many questions as they should. And so some people I don't think they have questions because they don't know the exam. Some people I just don't think they're asking enough questions. So if you're one of those categories that struggle in the first exam and are not certain about things on the exam, please come talk to me. I realize that you may have a clear understanding, but if you have a clear understanding, but if you have any confusion, please come see me and talk to me, ask questions. You can do it over the weekend too. That's absolutely perfectly fine. I'll answer emails. I try to do that. But yeah, I encourage you to do that. Yeah, so that's what we've got coming up, and then we'll have our presentations in the last week. But it seems like we shouldn't be at this point in the semester. We're in week 13. It just seems like we shouldn't be done already, but we're almost done, which means that you all are ready to go on and become auditors on the real world. You know, you feel comfortable, feel ready for that? Yeah. Some of us can't even upload the right file for Brightspace. Not going to mention any names. So yeah, should have been auditing that. Should have been auditing that work right there. Chapter 14 and 15, that was basically the first part of the finance and investing process. So first of all, did everybody catch the dance? Okay, everybody enjoy the dance? All right. Yeah, a little bit of a dance, Ray gun. I did tell you that was going to be coming up. No dancing today, unfortunately, but we got a little bit more of the same. I'm going to close the door. But yeah, today's the wrap up. We're going to talk about cash. We're going to talk about investments. Cash is very easy, but it's really important to talk about. Why? Because cash is very, very liquid. Okay. So what are we talking about? We're talking about cash, currency on hand, currency, cash in bank accounts, which includes CDs and time deposits. Okay. As well as savings accounts, which is all pretty intuitive and pretty straightforward. But if you remember, when you talk about cash on the financial statements, it's usually paired with something called cash equivalents. Has anybody ever questioned cash equivalents? Like when you were in your Dr. Ison's class, says, Dr. Ison, what does cash equivalents even mean? And then he said in his typical Dr. Ison's like, that's a good question. Yeah, so let's think about that. What do you guys think cash equivalents means? Yeah, so that would be that'd be Dr. Ison's approach. What are cash equivalents? So I give you some examples of treasury bills, money market funds. These are short-term, highly liquid investments that are readily convertible to cash, or they're very near maturity, so they have low risk of change in values. This has been an interesting topic because I've been talking with other classes about cryptocurrencies, and do cryptocurrencies count as cash equivalents? The answer is no, because of their inherent volatility. We cannot really classify them as that because they change in value very, very quickly without much notice. They're much closer to like volatile investments, but as Chandler would tell you, they're intangible assets, right, Chandler? Yeah, so intangible assets. So that's really beyond the scope of this particular chapter, but for context of cash equivalents, we're talking about something that effectively is cash, effectively will be changed to cash. And they're usually combined for presentation of financial statements, which makes things very easy for us. Now, why are we talking about cash? And the answer is cash almost literally, almost entirely, not fully entirely, but for the most part, affects everything that we've talked about in this course. So revenue and purchases, obviously they operate with cash receipts and cash disbursements. We talk sale of PP&E or issuance of long-term capital stock. We actually get cash for those. We have to disperse cash for payroll and long-term debt and stockholders' equity. And then as well, for purchases include inventory and PP&E purchases. So everything that we talk about in our process areas are affected by cash in some way, shape, or form. So we need to know how to audit cash. The good news is that's not really hard, and we're not going to be learning a whole lot of new stuff, but the stuff that we are going to learn is really important. So there are three types of cash accounts we generally want to discuss. So we have general cash account, which is just as it sounds. It's basically the cash account that's used for overall company functions. We have something called impressed cash accounts. Has anybody ever heard that term impressed before, an impressed account? So it's a special type of bank account, and it represents cash that is set aside for a specific purpose. Cash that is set aside for a specific purpose. An example of this might be payroll. You have a separate bank account for your payroll flows. And so cash is set aside in this payroll account to make sure the payroll can be maintained. A lot of organizations, they have impressed cash accounts that maintain more than what their payroll balance is. Usually they maintain 6 months of payroll. The idea being if there's a catastrophe or if there's a problem, if there's some sort of some fiasco, they at least can maintain operations for 6 months and pay their employees for that length of time. So that would be an example of an impressed cash account. And then branch accounts. Branch accounts are fairly intuitive, but why do we talk about them? And there's a very, very important reason why. So we've got a very big superstore that's just down the road. Everybody know what I'm talking about? It's where you all spend your weekends hanging out because it's the pop thing to do. Go to Walmart, some of you work there. Okay, some of you work there. And so over at Walmart is a multinational organization. If I don't know what their main banking system is, we'll say Bank of America just for context. Okay, we'll say Bank of America is Walmart's general cash account. So it would be easier if all Walmarts just opened their bank accounts at Bank of America and operated from those, so they'd only have one consolidated bank account. What is the problem with doing that here at the Kirksville Walmart? Do we have any Bank of America branches here in Kirksville? We do not. Okay. So in order to be able to have cash on hand for their operations, they need to have a branch account at a different bank account. So like they could be Bank of Kirksville, I guess it's Equity Bank now, it's what it's called, Equity Bank, US Bank, one of those operations nearby that they could actually operate from. It's not part of their main cash account. It's considered to be a branch account for operations for different locations that don't have access to the general cash account. All right, so for control risk assessment, we're going to skip inherent risk because inherent risk was embedded with the other things that we've already talked about. Inherent risk with cash is somewhat low for financial reporting purposes, generally high when we consider it from fraud risk, which makes sense because cash is very liquid, therefore very susceptible to fraud. So we're going to talk about the controls related to this. So cash receipts and cash disbursements, I've got great news for you. We're not learning anything new. These are all the things that we've already talked about in chapters 10 and 11. Remember those tables? So it was tables 10-7 and 10-7, 11-7. Those are controls related to cash receipts and disbursements, respectively. You're already going to have to learn that for the exam, so there's no point in me going over that all over again. But we do have an additional cash control that we do need to discuss, and we also need to talk about how we audit it. This cash control is the periodic, usually monthly bank reconciliation. So, yeah, bringing back Dr. Eisen, yes, yeah, we're going to be doing bank reconciliations in class today, guys. And this is kind of fun. I really enjoy bank reconciliations. My Dr. Eisen impression needs some work. Okay, I actually need to grow like 5 feet taller. So So bank reconciliation. So the good news is, if our client has effective bank reconciliation procedures, the auditor may choose to test the entity's reconciliation procedures as its test of controls. Now, we've never really thought about that. We haven't really classified that as control, but that's effectively what a reconciliation is that it's a detective control. It's a detective control in the cash process. And the idea being is that if there is anything outstanding that we can't rely upon, then it will be detected as part of a reconciliation procedure. Now, we're going to go into the details of what takes place in the testing of the bank reconciliation procedure from an audit perspective. Before we do that, though, let's talk about substantive analytical procedures. Now, here's a question from the venerable Dwight Schrute. Okay, does cash have a predictable relationship with other financial statement accounts? What do you think? Answer is false. Okay, it does not have a predictable relationship. Why is that the case? Think about it. A predictable relationship would imply that some other account affects another account directly. Okay, so are there accounts that have direct effects on cash? Certainly. If we had we could say revenues affect cash, but are those the only thing that affect cash? No, because we also know that purchases also affect cash. So if I were to develop a model saying, okay, I'm going to use revenues to determine what cash balance should be, would that be very effective? Probably not, because I'm leaving out all of the other things that might change the cash amount, all the other type of cash flows. You all learned about this, probably learned about it in 221 and in 302. Remember that, or maybe 303, one of those classes. Remember the statement of cash flows, okay? How many items are on that statement of cash flows? Like 1 or 2? Like usually a dozen or so items. All these things can affect cash. So it's hard to make a prediction. So the auditor's use of substantive analytical procedures for auditing cash is going to be limited to comparison of the prior year's cash balances, so trend analysis, and comparisons with budgeted amounts. And that's it. We basically cannot use analytical procedures very well at all for cash. So if that comes up, if say cash, we're going to use analytical procedure for cash, you're going to stand up and shout during the exam, Dr. Barnes, you are trying to fool us. That's not going to work, okay? You're not fooling me this time. Actually, please don't stand up and shout. You can write it in caps on your exam, but don't shout. That would be destructive. All right. For substantive tested details, we're going to talk a little bit about it more in context with respect to tested controls, but we're going to test transaction events and account balances. This is an interesting one. We generally don't test rights and obligations as part of testing cash. Does anybody want to know why? Or does anybody know why, I guess I should say? So rights and obligations, so right to assets. So who usually has the right to claim cash as an asset? Whoever has the cash, okay? Look in your wallet. Who owns that cash? The person who possesses it right here and now, okay? Cash is a bearer instrument, which basically means that if you possess it, you own it. That's how we view it. So possession of the cash is considered to be ownership. Now, this is a little bit more challenging when we're talking about digital or electronic transactions because those don't represent actual currency. But for the most part, we consider cash to be a bearer instrument in all forms. So rights and obligations is not really relevant. We don't have to determine that you have the right to own cash. So we're going to talk about these tests right here. These tests are fairly straightforward. And the good news is these relate to cash receipts and cash disbursements, which again, we've already talked about. We talked about cash receipts and revenue process. We talked about cash disbursements in the purchasing process. So everything that we already need to know, we've already learned, which means that we limit it down to one area. For this particular chapter, we're going to talk about bank reconciliation procedures. So we're going to do a few items, and there's a list of how we actually test the bank reconciliations to the account. I do want to note here, I do not like the terminology that the book uses. It tends to use the word trace when they don't mean trace. They usually mean agreement, because cash testing is usually a big valuation test, all right? So for existence, usually we're going to be confirming with the bank account balance of the institution, which we'll get to here in just a second. And then testing the bank reconciliation, we test for mathematical accuracy. We trace balances to the book to the general ledger, which I would say that this is more of an agreement. This is actually trying to agree one system document to another system document. Obtain standard bank confirmation, trace balance back to the book, back to the bank reconciliation. Again, I think that's an agreement, which we'll talk about the bank confirmation. We'll also talk about the cutoff bank statement, agree the deposits, transit, outstanding checks, and other reconciliations to the cutoff bank statement. These are both source documents, so it's not really directional. And then we'll talk about these tests right here, these additional tests that we'll perform if fraud is suspected. So let me go ahead and break down what we're going to be talking about here in a second. We're going to talk about 3 specific procedures that we need to do to test bank reconciliations. You will need to know all 3 procedures and what is involved in those procedures. The good news is that the homework will actually go into detail on this, as will I here in just a second, okay? There are also 3 additional procedures that you do not need to know what they entail, but you need to know what their names are, okay? You need to know what they represent. I will give you a summary of that. So these are only if fraud is suspected. If we think that something is going on with cash that is misstated for fraudulent purposes, we would perform these additional procedures. All right. So let's go ahead and talk about which documents we need for testing cash, what it is that we're going to be doing, all right? So what is probably the very first document, if we want to test the bank reconciliation, the very first document that the auditor should acquire? The bank reconciliation. The bank reconciliation, we want to obtain that if we're going to test it, okay? Test the bank reconciliation. Remember, the bank reconciliation is just trying to validate the difference between the stated bank balance and the stated book balance. If we were operating on a cash basis, if we were operating on cash basis instead of crazy accrual basis, these numbers would be identical, okay? Or at least they should be identical. But because we operate on an accrual basis and we recognize transactions before we receive cash and blah, 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 the cash amounts can be different. So we need to determine why are cash amounts different. So remember, when you learned about this back in whatever class you remember this from, part of the big reason for this statement, these differences are going to be due to reconciling items both on the bank side and the book side. Bank side are usually items that are in transit, are moving towards the bank, but have not yet cleared. So outstanding checks and cut or deposits in transit. This can also be additional reconciling items on the bank side that have not occurred, like maybe a transaction that they failed to record, maybe an error on that end. It doesn't happen very often, but it does happen. And then the items that are on the book side are usually transactions that have not been recorded by the client. Okay, so bank charges, non-sufficient checks, things along those lines. You don't need to remember all of those items. You don't need to remember how to bank or reconcile a bank, do a bank reconciliation. I hope that most of you would remember most of this, the bank reconciliation. It's like, well, that was 302, Dr. Barnes. We've slept since then. But yeah, for the most part, it's not too difficult to understand that we're just trying to determine what are the items that validates the differences between bank and the book balance. So bank reconciliation is our first item. We're going to break this down into 2 parts, okay? So what we're ultimately trying to prove as auditors is the book balance. Why are we trying to prove the book balance? Because the book balance is what is in the financial statements, okay? So what do we know about the characteristics of the book balance? The characteristics of the book balance are that it's the bank balance plus or minus any reconciling items, okay? So the book balance, to prove the book balance, all we need to know is that the bank balance is correct and that we prove all the reconciling items, okay? This seems pretty easy, straightforward enough. So let's go ahead and talk about how we do that, It's actually pretty straightforward. It's pretty straightforward. So if I want to know what the bank balance is, so again, I'm trying to reconcile the bank balance to the book balance, I'd have to know what the bank balance is. What's the easiest way to obtain the bank balance? Ask the bank, okay? So the bank is a third party. What do we call a third party request? Confirmation. So we're going to send out a standard bank confirmation. And this will just basically say, here's what the reported balances are, or here's what the reported balances are. Can you confirm whether these are correct? This is a traditional confirmation as we looked at before. By the way, which of these assertions do we think is probably most relevant in a standard bank confirmation? Because we said confirmation could test multiple assertions. Which one do you think is the most important, the primary assertion? So it's an asset, so it's probably Existence occurrence, okay? So remember, our assets and revenues, we generally focus on existence occurrence. If we're talking about liabilities, equity, or expenses, it's usually completeness, okay? We want to make sure that these are not overstated. So yeah, assets and revenues, existence occurrence, liabilities, equity, and expenses, usually we're going to be focused on completeness. That doesn't mean those are the only assertions, but those are our primary assertions. So just a refresher on that. All right, so we've got our bank balance. We're trying to confirm our book balance. What's in the middle? All of the reconciling items? Okay, so some of these reconciling items we might have to test directly. Some of them we might have to say, all right, you made you recorded a transaction that the bank didn't record. We need to determine if that's the case. But for the most part, most of these reconciling items are items that are just waiting to clear. So like a check's been written, but the bank has not received it yet. All right, does that sound like a reasonable reconciling item? Or a deposit's been made, but the bank has not put it into the bank account yet. All of those sound pretty realistic and consistent. For the most part, our reconciling items are all items that are waiting to clear and will do so at some point in the future. So would it be fair to say that to test the reconciling items, all we have to do is look into the future? So our third document is a crystal ball, okay? And we hire a soothsayer to actually determine what happens in the future. And no, I'm joking, okay? What would we do? So audit engagement usually takes like several weeks or maybe a month. Is that long enough for the bank reconciliation items to clear? Could I wait like maybe a week or maybe 10 days and wait until those clear? Absolutely. Okay. If I've got checks or if the company's got checks in transit, my client has deposits in transit, I can just wait and say, all right, I'm going to wait to see those hit the bank account. And if those clear, I know they're legit. This is something called a cutoff bank statement. Okay. So we look at the date of the last bank reconciliation. We request from the bank in 7 or 10 days or some arbitrary amount in the future, can you please send us an updated bank statement so we can see if these items have cleared? If the items have cleared, that's proof that they were legitimately included on the bank reconciliation. What happens if the items do not clear? That's where his auditors say, all right, there's a problem here. You said there was a deposit for $1 billion, and that has not cleared the bank account yet. I have suspicion that this is probably not a legitimate deposit. And so whatever gave you that idea? Was it because I said $1 billion? Yes, probably so. Probably so. By the way, if you ever see a deposit for $1 billion, I would just be suspicious of that just in general. I don't think you need to worry about the cutoff bank statement. All right. Those are our 3 procedures. Again, so how are we going to test? What are some additional tests that we're going to be concerned about? So we're going to be verifying the mathematical accuracy and agreeing the balance books and general ledger. We're going to agree the bank balance and the reconciliation of the balance shown on the bank confirmation. Okay, so we want to make sure that the information in the bank reconciliation is correct, that they've actually done their math correctly. We want to actually verify that the balance that's listed in the bank reconciliation equals the general ledger, because the book balance, remember, that's what we're ultimately trying to test. So if the bank reconciliation number is different from what's in the books or what's actually in the books, there's a problem. We want to make sure that we agree the bank balance and the reconciliation of the balance shown on the standard bank confirmation. So that top line needs to have a confirmation associated with it, okay? We're going to compare the deposits in transit to the bank reconciliation of the cutoff bank statement. So if it's a deposit in transit, it should clear the bank at some point in the future. That's why we have the cutoff bank statement. We can also use the cutoff bank statement for checks, but we can also check and make sure that we have canceled checks associated with that. So this is kind of an old school reference, but does anybody write paper checks anymore? Just maybe occasionally, okay? So when the bank sends the reconciliation back to you, usually you get a copy of that check and it's like said void on it, or they have a printed document that has a picture of the check on there that shows it's cleared. That's a canceled check, okay? Then we can use that as additional validation in addition to the bank statement. We want to make sure that we agree any charges included on the bank statement to the bank reconciliation. It's important to note that usually the testing on this is not as thorough as the checks or deposits in transit, mostly because these transaction amounts are usually immaterial, very, very small in nature. If you do have a charge or if you do have some sort of item on there that needs to be reconciled, that's a large amount. So say, for example, a $10,000 charge that's not related to a purchase or not related to a deposit, then you might want to do some separate testing. But for the most part, if it's a bank charge of $6.95, auditor is just going to accept that as is because it's not material. And then agree the adjusted book balance to the cash account lead schedule. So the amounts that adjusted amount, this is what's in the cash account lead schedule, which is used in the trial balance testing and the financial or the working papers. All right. So a lot of stuff there, but it's all fairly straightforward. It's all fairly straightforward. The most important thing to remember is we need our bank reconciliation. We need our proof of the bank balance in the bank reconciliation, which is listed in the standard bank confirmation. And we need evidence of all adjusting items, all those reconciling items, which is going to be our cutoff bank statement. If you remember those three things, that's going to be 90% of this part of the chapter. It's going to be 90% of the questions in that area. All right. By the way, I want to make a note of this. Okay. The reason why I use the word agree when the book uses trace is a completeness specific term. It's usually determining source to record. Vouch is record to source. When I say agree or compare, that's usually a source document to a source document. So if you're wondering why I'm so insistent on the vernacular, it's because this is kind of how I view agree and compare. I don't think tracing is a word that should be used just willy-nilly. I wish the book agreed with me on that. So, all right. So what happens if the client does not have adequate controls over cash, or if there's some type of fraud involving cash? This is where we extend bank, or we do additional bank testing procedures. Again, you do not need to know exactly what this entails. You will actually look at an example of this. There is a proof of cash in your homework assignment, but it's pretty straightforward. So we're going to be doing three possible procedures. The first of these is we're going to extend the audit procedures over cash. That's the general term for this. So that entails possibly extended bank reconciliation procedures. So extended bank reconciliation procedures say instead of testing a bank reconciliation at a point in time, we will test it over a period of time. So we'll look at all transactions and all changes that occur over maybe a month-long window to determine if we can understand the source of fraud that might be occurring. We can also do a proof of cash, okay, a proof of cash. So ever remember when we were talking about fixed assets in the chapter 14, 15 lecture, and I said we test additions and disbursements or additions and disposals? We can do something very similar for that with respect to cash. We can look at the cash balance at the beginning of a period, the cash balance at the end of the period, and we can test everything that changed during that period. And that will give us validation of what the end of period balance is. And then something that's less common, but still kind of occasionally used is something called tests for kiting. And kiting is basically an old school scheme. This occurred quite a bit back in the 80s and 90s, less so nowadays, where basically somebody in the organization takes advantage of what's called the float. Have you all heard of the term float with respect to bank? That basically means that when you write one check from one bank and it gets deposited another one, there's a gap in time in which the check that you wrote has not cleared the bank that you wrote it from. So it takes a little bit of time. Really, what's the word I'm looking for? People who are very, very insightful and people who are not very ethical found out about this, and they said, you know what? We could just continue writing checks in between bank accounts and inflate the balance in both accounts if we do that. So that's what kiting is called. We're not going to go into detail about what kiting involves because it's not as commonplace anymore, simply because electronic transactions tend to clear much, much more quickly than they used to back 20, 30 years ago. That being said, especially in small towns like Kirksville, kiting can still be a big problem. And that needs to be something that an auditor needs to be aware of as a possibility if we're going to be concerned with how we test cash. All right. So auditing an impressed cash account, which would be payroll or a branch account, follows the same basic audit accounting steps as a general cash account. And then we can talk about petty cash. This is cash that's used for minor expenses. Again, this is less commonplace than it used to be, simply because a lot of these transactions are now electronic. But are we going to use substantive procedures for testing petty cash? The answer is no. Part of the reason for that is because petty cash was just as it says, it's petty. It's usually a non-material amount. But what we are going to test controls over this. We want to make sure that we understand who can access these items, who has access to the cash, and make sure that the separation for the access to cash and the recording of the transactions is separated. So again, segregation of duties that exist with respect to petty cash items. Last thing about cash. So auditor must evaluate several types of financial statement disclosures related to cash. So some of the more common disclosure issues are policy for defining cash and cash equivalents. For many organizations, particularly the large ones that we're going to be talking about in this, we talk about in this course, I shouldn't say we are going to be talking about, that we have talked about in this course. This is going to be consistent for all of these, but this may change on smaller organizations. We also want to make sure we understand restrictions on cash, such as sinking fund requirements. Does everybody know what a sinking fund is? So it's very similar to an impressed account, which is like cash set aside for a specific purpose, but this is a sinking fund is something that's being aggregated for a particular purpose in the future. So say, for example, they're constructing a new piece of equipment, like or a new building. They might set aside $10,000 per month for the next 30 months. That would be an example of a sinking fund. Contractual obligations to maintain compensating balances. So compensating balances usually occur whenever we've got contractual arrangements with a financial agency. The most common place this happens are line of credits or loans. Usually when that happens, then the agreement says that you have to maintain certain ratios and you have to maintain a balance in a separate account of a certain amount. So if you've got $1 million loan, they may say you have to maintain a $100,000 cash balance at our bank account. That would be a compensating balance. Cash balances are restricted by foreign exchange controls and letters of credit. All right. So that pretty much does it for cash. Again, a big focus of this particular area is going to be on the reconciliation procedures because that's something new that we're talking about. It's a very important procedure. It's a very straightforward procedure though, so it shouldn't be too scary for you. Last thing we're going to talk about is one that's a little bit more obtuse. It's a little bit more subjective. This is going to be testing investments. Now, the good news is what we're going to talk about in this section is identical to what we talked about in chapters 14 or 15. The big difference being is that instead of being the issuer of these items, instead of being the issuer of debt, instead of being the issuer of equity, we are now the ones who are purchasing debt and now purchasing equity. And a lot of our assumptions are going to remain the same. So what are we talking about? We talk about investments. We're going to be talking about common stock, preferred stock, debt securities, and hybrid securities. I meant to take a drink before I started talking about this because I was really thirsty. All right, my apologies. So these are all things that we consider investments from a traditional investment perspective. For clients with large investment portfolio, the auditor is likely to follow a reliance strategy. Okay, now everybody's excited because I use the words reliance strategy. Okay, so reliance strategy basically means we have to rely on testing controls, and the only reason that we mention this is because there are organizations out there that their entire business strategy is investments. So an example would be like a mutual fund. If I was an auditor testing a mutual fund, I would have to look at controls very, very thoroughly in much detail because the controls surrounding this dictate their entire line of business. Most organizations, though, they do not have large investment portfolios, or their investments are considered to be an offshoot of their main business model. So for a client that does not require an audit of internal controls or financial reporting, it is usually more efficient for the auditor to follow a substantive strategy. And this is the first time we get to celebrate here in class, okay? Because the last time I did it was online. So hopefully you did a little celebration with me on Monday. But what does this mean? What did we talk about with respect to substantive strategy? What was the rationale behind using a substantive strategy? I talked about it with respect to long-term debt, long-term assets, or property, plant, and equipment. Talked about it with respect to long-term debt and substantive stockholders' equity. And I said there was a very big reason why we generally rely on a substantive strategy here. Does anybody remember, or why we use a substantive strategy? Does everybody remember the discussion? So what is the nature of transactions? Are there usually a lot of transactions or a few transactions within those areas? A few transactions, okay? In that case, it's easier to test the transactions themselves rather than the surrounding controls. This is the reason we make the delineation here. If we're talking about a business model that's entirely investments, we have to test controls. That's part of their operations. But if we're talking about a business model that they have some investments and they're very infrequent, let's just test the transactions themselves, test the investment transactions. That's our substantive strategy, and that's usually where we utilize that. So again, getting away from those tester controls, because nobody likes testing controls, not even me, okay? Nobody wants to test controls if they don't have to. All right, so assertions over investments. We have completeness. We want to controls to ensure that all security transactions are recorded. We have existence occurrence. Controls ensure that a purchase or sale of any investment is properly initiated. And authorization, controls that ensure that initiated prior purchase of sales investments are properly authorized. You may say, wait a minute, Dr. Barnes, you said authorization isn't a real assertion, and you're absolutely right. It is not a real assertion, but authorization over transactions is really, really important to discuss. So I included it in here because when we talk about the nature of investment transactions, we don't want our client engaging in transactions that are not properly authorized. Technically speaking, this should be part of existence occurrence, though, and authorization is not a real assertion. VAA, really important, controls to ensure that appropriate amounts are used to value investments for financial statement purposes. Presentation, controls ensure that securities are properly presented and disclosed. Classification, they're properly classified. I didn't put cutoff up here. What's the heck with it? What's the deal with cutoff? Cutoff is not a real big concern. It's unlikely that there's going to be cutoff issues with respect to investments, so we don't actually have to worry about testing cutoff in most scenarios. All right, segregation of duties. The initiation function should be segregated from the final approval function. So what are we talking about that there? Usually initiation implies recording. Final approval probably represents authorization. So we're separating out recording and authorization. Valuation monitoring function is segregated from acquisition. Valuation monitoring, that's a recording function. Acquisition is going to be our custody function. Responsibility for maintaining securities ledgers to be separated from entries in the general ledger. This sure sounds like redundant recording responsibilities, which we've talked about already. And responsibility for the custody of securities should be separated from that from the accounting of securities, okay? Which is going to be separation of custody and recording. This should be similar to what we talked about in stockholders' equity. Remember when I talked about the equity in chapter 15, I said, look, controls for the most part, we're going to ignore because this is going to be substantive procedures. That being said, true segregation of duties is really important with respect to stockholders' equity. It's also really important with respect to investment. So we need to make sure that pure segregation of duties exist. And these are some examples of those. All right. We're going to get into a little bit more detail on that here in just a second, but I want to talk a little bit about substantive analytical procedures. So they can be used to evaluate the overall reasonableness investment and income statement accounts. This is usually in one situation we can develop a model. Situation we can develop a model is where we can develop reasonable expectations. Again, this goes back to the idea of interest expense and being related to our lines of credit and our bonds. Remember, we talked about that with respect to long-term debt, and I said we can calculate interest expense and we can usually make a good approximation of that. The same holds true for interest revenue. We can actually calculate interest revenue along those same lines because we know what the amounts should be or the percentages are for those investments. Can we do the same thing for dividend revenue? What's our general answer when we don't know the answer to a question? What should be your default response? It depends, yes, and that's the answer to this question. It really depends on the type of dividend. If it's common stock dividend, the answer is no, because common stock dividends are not required and there's no set amount. If it's a preferred dividend, the answer is yes, because preferred dividends are required to pay out at a certain amount. So it depends on whether they're common dividends or preferred dividends where we can develop a model on those. So what are some examples of this? Comparison the balance of the current year's investment accounts to prior year balances, trend analysis. Comparison of current year interest and dividend amounts with reported income for prior years and expected return on investments. Okay, so that's just basically looking at trend analysis as well. We also want to recompute current year's interest income using the face amount of security held, interest rate, and the time period held. So usually we're going to be isolated to interest revenue in this or interest income. We can do some dividend analysis if they're considered to be preferred dividends, but that's usually the only scenario. Okay. By the way, I want you to thank me, okay? I did actually do a investment computation question on the exam without any preparation in prior years. I got rid of that this year, okay? So I did a much more straightforward question. I want you to make sure that you note this. It was only worth 4 points, so if people missed all the parts of the question, they only lost 4 points. But I had some of my most talented students in previous semesters that just left it blank because they were just completely and totally confounded by it. And I was just like saying, come on, guys, this is not that hard. And apparently it was that hard. So I did take that into account. All right. Substantive tested details. We're in our substantive procedures now. So we're going to be testing our account balance assertions. What do you guys think are some of the most important assertions related to investments? What do you think is the most important assertion with respect to investments? Our primary assertion. Well, investments are assets, so it's probably the existence occurrence. Yes, existence occurrence. Okay. Again, remember, usually when we're talking about assets, when we're talking about revenues, our primary assertion is going to be existence occurrence. We're talking about liabilities or equity or expenses. It's usually going to be completeness. Not the only assertion, but it's definitely going to be one of the prominent ones. And this is our most critical assertion with respect to investments. So what are we going to do? Well, keep in mind that we have two approaches. If our client possesses the actual securities related to the investments, we can go and we can look at those investments and test them directly. This is called physical examination of the investments. It's very similar to inspection of tangible assets, though it's a little bit different. It's more of an inspection of records of the documents, to be honest. But this would give us a lot of assurance if we can actually look directly at those items themselves. On the other hand, in many situations, especially for large companies, most organizations do not hold their investments themselves. They usually have brokers, they have investment dealers that hold them for them. They actually manage them and maintain them. Those are third parties. What do we call a communication with a third party or request to a third party? Confirmation. So we can send out confirmation. So we can talk to the issuer or to the custodian. We can confirm any unsettled transactions with the broker dealer. So anybody who's responsible for maintaining transactions with the entity. We can confirm with the counterparty, which that's the company that would issue that, or that are responsible for the issuance. We can also read associated documentation to make sure that those are legitimate. This would be like board of directors meetings minutes or loan agreements associated with that. So not loan agreements because loan would imply loans, but investment agreements, I guess I should say. So again, our primary source of information here is going to be looking at the documents themselves or confirming those with a third party. And those are going to be really, really strong test of existence occurrence. Now, that's not our only assertion, but that is our most critical assertion in this area. Let's go ahead and speculate. What do you guys think would be another assertion here that might be relevant to investments? Okay. Now, completeness probably could be, but it's not a critical assertion. It's very unlikely that, especially for large investments, that an organization will have one of these investments and then fail to record it. That just doesn't happen very often. So what is going to be another one that we might think about?
Yeah.
VAA, okay. Are there valuation issues with respect to investments? And the answer is you betcha, okay. So what happens if there's been any changes other than temporary to the fair value investment? For example, if a fair value is significantly below cost, have you all encountered that in your other accounting classes before? I hope so. Otherwise, I'm speaking to a blank room. Yeah, I say that. So I'm assuming that this is a 302 thing that Dr. Eisen, I'm not going to do my impression this time, but Dr. Eisen actually talked about, where he said that if the investment value is determined to be impaired, remember I've heard that term before, impairment investments, the security should be written down and new carrying amount should be established. So this is one big concern with respect to investments is whether or not their fair value accurately reflects what they cost. Okay. If their fair value is significantly below cost, we reduce it to a new fair value. So that's one aspect of VAA. Another one that you all may remember is related to VAA is going to be how we actually categorize and what the valuation is. Now, to be honest, that's not as much VAA as it's going to be considered presentation and classification. But remember, investments can be categorized according to when you plan on disposing them. They can be held to maturity, trading, or available for sale. Why is this important? Because held to maturity, available for sale securities are going to be classified as non-current assets. So long-term assets, unless management expects to convert them to cash within 12 months. But trading securities are classified as current assets. Why is this so important? Why is this concept so critical? The idea behind this is that we need to understand how investments are classified to prevent misreporting of those balances with respect to ratios. So let's say that I report an available for sale security as a trading security. Does that really change anything from the investment valuation perspective? The answer is no. But will that affect liquidity calculation for the organization? Yes. And as I mentioned earlier, compensating balances with agreements are usually paired with covenants. We usually associate with debt covenants. One big debt covenant is that current ratios have to be maintained at a certain level, like maybe 1.2 current ratio. How do companies get past that? They like to reclassify items that are long-term as current assets, or reclassify liabilities that are current as long-term. So we have to be very much aware of that because that is a very, very burgeoning area of misstatements that could occur, a big area of misstatement that could occur that we're be concerned about. Also, one other thing we talk about auditing fair value measurements, that ASC topic 820 has a fair value hierarchy. Okay, so there are 3 levels that we can actually utilize to determine what fair value represents. Okay, so this goes back to our valuation consideration. So the one that you're probably familiar with is called mark to market. Has everybody heard that term before? Now, this is not like the mark to market that Enron is doing that threw everything in disarray. That was not even really mark to market. That was mark to whatever Enron could use to make money. Okay, that's how I call it. Mark to Enron makes money. You know, that's how we call that. So mark to market, what does that represent? That is basically valuing investments at what their quoted market price is. So I've got 10,000 shares in Amazon. Can I tell what that market value is, that fair value is? And the answer is yes. I can go and I can see what Amazon is trading for currently. I can multiply it times 10,000. I can say that's what my investment value is. That's pretty straightforward. And can we say that that's an objective measure of fair value? I hope so. I hope so. If that's not an objective measure, then the rest of them are going to get very, very problematic. Okay. So then we have mark to matrix. Has anybody heard mark to matrix before? I'm getting to stuff that you haven't heard before. So mark to matrix basically says that we do not have an open market for a particular item. So it's like a share of Amazon, but it's not a share of Amazon. Okay, it's something else. It's a share of Amazon, generic Amazon. Like, you know, go to the grocery store and you want to buy Chef Boyardee, but you can't afford to pay for that, so you buy generic Chef Boyardee. We've got generic Amazon. Okay, it's not nearly as much. Okay, so there's no market that trades in generic Amazon, but we can actually compare that to Amazon and say it's realistically it's a similar asset to Amazon. So we can trade that in a similar market. We use a similar asset to value. Now, is that an appropriate valuation? And the question is that's a little bit more subjective, okay? Is generic Amazon the same value as actual Amazon? Probably not. But in lack of any other information, lack of any other best judgment, that's what we're going to use, okay? So that's an example of mark to matrix, using something similar to it to use for evaluation. So you're probably squirming a little bit saying that was really, really rough, Dr. Barnes. That was really rough. Well, then we have mark to model, okay? Mark to model. What do you think that means? Mark to model means not only do we not have a market for a particular investment, but there are no other similar investments that represent it. So how do we determine fair value on a mark to model investment? The answer is management estimate and judgment, okay? Which those are words that you never want to hear as an auditor. You don't want to rely on management estimate and judgment. Now, they'll usually use some sort of reasonable approach. But what do we note about this, okay? If we go from level 1 to level 2 or 3, we're taking objective measures, which are market measures, and we're replacing them with subjective inputs. Subjectivity from an audit perspective is really problematic. The more subjective it is, the more problematic it is to determine if it's a fair valuation, true approximation of fair valuation. So if we're trying to evaluate fair value for VAA purposes, and we look at a mark to model investment, the answer is we don't know if that's a fair value or not, because that's entirely up to management's discretion as to what they list there. So we would like as much as possible these to be level 1 investments, but sometimes we may have to delve into level 2 and level 3. All right, last slide. AUC 540, audited accounting estimates, including fair value accounting estimates, related disclosures, specify the auditor should do as follows. So the very first thing we need to know is we need to obtain an understanding how management makes fair value measurements. This is really critical, particularly if we're talking about items that are very challenging to obtain fair value for. So if we're talking about level 2 and level 3 investments, we need to have a very clear understanding of what management's procedures are. We also would like to see the computations and how they made those calculations and try to replicate those if possible. Recomputation become a very powerful tool here, especially if we can employ somebody like an actuary that can perform the same calculations as the management has made. That leads into consider whether specialized skills or knowledge are required. Has anybody ever done a Black-Scholes model calculation? I don't know why I'm raising my hand. I've never done one either. Okay, all right. So that would be one that I would be very, very concerned about. If I needed actuarial skill, I would need somebody who can actually perform the calculations. This is not something I'd want to do on my own. Auditors will frequently employ specialized skill sets for things like this that require subjective estimates. For investments are a big area of that. That would be one where we'd want to actually bring in somebody with specialized knowledge in that area. We need to then test these fair value measurements. We need to determine what the value is, establish that valuation, and determine if what our expectations are, match those, and then evaluate the reasonableness of the fair value measurements. Now, this is going to be very similar to a substantive analytical procedure. Our ultimate conclusion is, are we within the scope of what our expectation is? It would be very much like that, except it's not exactly a substantive analytical procedure in the fact that we're looking at very specific details used to make those measurement calculations for fair value. That being said, fair value measurements can be very, very difficult, at times very dicey to come up with what a proper conclusion is. It can be very misleading if not done properly. So auditor's goal in this area is to make sure that there's a lot of transparency, both on management side and the auditor procedure side, in order to make that conclusion. Sometimes you will see in critical audit matters that the testing of fair value measurements is a big area for disclosure within the critical audit matters section of the audit reports. All right, that does it. Congratulations, guys, you made it. Woo! All right, we've got chapter 14, 15, 16 homework on Friday. So I will see you all then. Have a wonderful day. Stay dry.